Let's have a look at Warren Buffett's 1985 letter to Berkshire Hathaway shareholders. This was an amazing year for Berkshire. Firstly, the share price was up 95%, nearly doubled. It's funny because today we think of Berkshire as a conservative, kind of slow growth company, but back in the 80s, it was really a quote-unquote growth stock. As big as that 1985 share price run-up was, it looks tiny compared to where the share price is today. Now, obviously, Berkshire's a huge outlier. Most businesses will not perform this well over 40 years, but it's something to keep in mind. Just because an asset's value has doubled in a short space of time doesn't necessarily mean it's overvalued. What's interesting when you look at the share price over the course of the year are these bumps, roughly every 3 months. I haven't gone back and checked this, but my guess is these were reactions to their quarterly results. Every time they came out with quarterly earnings, the market responded very enthusiastically. Berkshire was probably killing it every time they came out with earnings. Here are the businesses that drove those earnings. Insurance was over half of Berkshire's business in 1985. Today, Berkshire's a lot more diversified. If you look back to 1985, Buffalo News, See's Candies, and Nebraska Furniture Mart were like a third of the business. Today, they don't even get their own headings. They're just part of much bigger business units. These 3 businesses have grown their earnings from $8 million in 1970 to $72 million in 1985. That's earnings growth of 16% a year. But what's more impressive is that these businesses only required another $40 million to produce this increase in earnings. In previous letters, we've seen how fanatical Warren Buffett is when he writes about return on equity. This is why. Apart from being an indicator of a great business, it allows for this kind of capital-light earnings growth. Otherwise, growing earnings by growing the amount of capital invested in the business doesn't mean much. Think of it this way. Anyone can double, triple, or even quadruple the earnings that a bank account produces. All you have to do is double, triple, or quadruple the money in the account, right? Assuming the interest rate stays the same. Well, we should apply the same thinking to businesses. Whether or not a company doubling its earnings is good depends on how much more money in the company was needed to generate those earnings. It's like the bank account. If the company doubled earnings but did so without needing more capital, that's really impressive because it's like a bank account that doubled its earnings without needing a higher balance to do so. We can almost think of a company's return on equity as being like the interest rate on a bank account. It's funny to say now because Berkshire's a lot slower growing now, but Berkshire was a high growth business in the 80s. Earnings nearly tripled in 1985 at a decent return on equity. This strong year in earnings drove Berkshire's book value up by nearly 50% to close to $2 billion. Again, when you compare it to the most recently reported book value of nearly $900 billion, there was still a long way to go in this story. Having said that, Warren Buffett was cautioning about Berkshire's ability to replicate that performance going forward. That was for a couple of reasons. Firstly, maintaining that growth rate required bigger absolute profit numbers. For Berkshire to grow its net worth by 15% over the next 10 years, it needed to get its book value to $7.6 billion. That meant they needed another $5.7 billion in profits over the next 10 years. Remember, they just did $436 million in profits this year in 1985. Secondly, valuations had risen quite a bit. In 1985, Warren Buffett is saying great businesses are being properly valued by the market, whereas earlier in the past decade, those great businesses were available for cheap. He gives the example of the Washington Post company. Berkshire bought its stake in the Washington Post at a valuation of $100 million in mid-1973. Warren Buffett valued the business at $400 to $500 million, so he felt it was at a discount of at least 75% when he bought it in mid-1973. Interestingly, although the business did fine in 1973 and 1974, its valuation had fallen another 25% since Berkshire bought it to $75 million by the end of 1974. After that though, 2 things contributed to it being a fantastic investment. One, earnings per share grew very quickly because the company grew earnings dramatically and bought back a lot of its stock at these bargain prices. And 2, The market took that 75% discount to intrinsic value and reappraised the business at a valuation much closer to its actual value. As a result, Berkshire made close to $200 million in 12 years on the $10 million it invested in the Washington Post. That works out to a return of 30% a year. This is kind of the dream scenario for any investment. Firstly, it's available at a discount valuation. Secondly, the business grows earnings dramatically over your holding period. And finally, the market revalues the business at a valuation ratio much closer to fair value. Bring on 1986.